Hello everybody, once again this is Chris from KMGB Consulting, here to show you some strategies that will change your life, mainly in the US market. We'll get right into it. And just some quick background for those who don't know me. Here I am with George Ross. I'm a lucky person to have a consulting call with him on a monthly basis, a tremendous resource. George Ross is Donald Trump's right-hand man, does all of Donald's due diligence on all the real estate holdings and buys and sells that Donald does. Over here, in my teens, a bit of a Kiss fan. Later on, many years later, met up with Gene Simmons for dinner. Fascinating man, a work ethic that I've just rarely seen these days, and a tremendous business tycoon. Down here we have J.J. Childers. He is our attorney in the United States, certainly a man to have on your side. He wrote the book on asset protection with Donald Trump here for Trump University. He is the one that we use to set up all our businesses in the United States to keep us protected. Because for most of you that have been down in the States, you've heard or you know that the United States is the land of the lawsuit, and this is the models that he puts together for us to protect us. I worked a lot with Al St. Clair. He's the lucky realtor of choice that we use to do all our green flips here in Toronto. Here's the one that we worked with, my business partner, Emmanuel Bellevaux, host of World's Greenest Homes, and my parents' place. We did 4 or 5 big green flips in Toronto. Wrote up in, we were on the media, certainly in Modern Magazine and several other publications. But here we go. Let's just take a look at some of the things that most of us as Canadians, the difficult part that I see time and time again is Canadians sitting on the sideline and missing tremendous opportunity. The sad part is not one of the #1 selling mutual funds right now is the gold mutual fund. And it concerns me because gold is way up here at the high point. And this is where we should be buying it. But typically we're starting to line up now and buying it at $1,800 an ounce. A little bit of a scary thing, certainly to me. It has a lot more downside than upside. And if you look at it seriously, your money at $1,800 an ounce, if you're buying at that sort of peak there, you need to increase or double your money. You're looking at a $3,600 price for gold. I'm not saying I have the crystal ball and know it will not go there, but the likelihood to me, since it's sitting at an all-time peak, is probably highly unlikely. Taking a look back to, most of us must missed a lot of this. In the early 80s, we saw unheard of interest rates, and I was around then, and I do remember the banks saying not to put your money long-term because they were saying that the interest rates would go higher. In fact, Canada savings bonds at the time were paying 18.5%. For their savings bond. A 1-year GIC was paying 21%. And the banks were all prescribing to go short-term because the rates, in their brilliant opinion, were going to go up. I remember going at the time, I had some money available, and asking my father if he had ever seen interest rates in the 18%. My father, who is now 80, born in 1932, said as far back, Chris, he's never seen rates like that. So I locked at the time with my limited knowledge in investing in a 5-year GIC at 18.9%. The interesting part, for those of you that are more sophisticated would know this, that the government of Canada issued a 30-year bond at the time, and the 30-year bond was paying 16.5%. And that bond just recently came due in 2011. For 30 years was paying 16.5%. That is educating yourself, getting yourself out there, talking to people, and finding what's available. We are looking at some of the lowest interest rates we've ever seen. This is an ideal time to borrow money to invest. Certainly borrow money to look at going into the U.S. is a tremendous, tremendous value, as you will soon see. Stock market. We saw in the early part of 2009, we saw the stock market really come down. Certainly had a tremendous drop in price. And at the end of the day, most Canadians at this point, sadly, took their money out of the stock market and put it into safer things such as GICs, Canada Savings bonds, and bank accounts. The wrong thing to do, obviously you can see now looking back with some hindsight, this would have been a tremendous opportunity to purchase stocks, but to stay in the game. And that's the tough part, is patience. Emotion gets in the way, and we make a lot of bad decisions based on emotion. We have everybody screaming sell, 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 and that's the time to say buy, buy, buy. But the problem is it's really tough when the emotion hits and comes into play. Let's just take a look. This is the most incredible opportunity I've ever seen in the real estate market. I've been investing since 1986, and I think, and I call it the U.S., is certainly the perfect storm for Canadians. I'll show you why. Right now the market is up to 60% off. We have seen it as high as 80, in some cases even higher. But right now things are starting to change. We're starting to see values coming back. The builders are starting to come back. And right now we're going to say that the market is 60% off for us as Canadians. What does that mean to you? 60% off means this. If you bought a house or condo down there that used to sell for $200,000, you can now pick that up at 60% off, or around $80,000. And here's the idea. When and if the market returns back or makes 120, so the market goes from the 80 to the 200,000, you're going to make 150% return. And then there's obviously the exchange rate. Right now, exchange rate is really favorable for us. It's pretty close to parity right now, which means that an American dollar can be exchanged for one Canadian dollar. For those you've been around, sometimes you've changed it as low as 65 cents, which means a dollar Canadian was buying you 65 cents or 65 cents American. So again, too, we've got the exchange rates playing very favorable. We'll talk more about that in a moment. But here's my advice. I would rather be in a market right now that's down with a tremendous upside rather than looking at the Canadian market, which I feel is at a peak value right now. I'm not going to say that it may not go higher. There are some factors that say it will. But from what I can see, certainly in Toronto and most parts of Canada, there is no cash flow whatsoever, meaning that you're making some kind of a positive rate of return on your investment. This is always a fun little slide that I have, but here are 4 different condos. 3 of them are from Canada and different parts of Canada, and there is one from Florida right now. And the fun part always is, which one do you think is from Florida? And the next part is that 3 of them are $300,000 plus, and one of them is $30,000. The fun part is, guess which one is which? And just to save some time, I'm going to tell you. This one is less than $30,000. How do I know? Because I own this one. I bought this one in 2011 in June, and I paid $27,900 for it, as you can see right there. Here's the nice part. It actually has a second story to it. It is 1,177 square feet. It's a 2-bedroom, 2-bath, 2.5 bath, they call it down there. They call that a 2.5. That's the lingo down there. Unbelievable deal. This is the condition I bought it in, which was pretty well brand new, or certainly updated. I've got a renter in there. It's cash flowing, and the price on this in the peak was somewhere around $195,000. Tremendous, tremendous value. This is in Orlando. It's close to Disneyland, Disney World, and there's lots and lots of jobs. What you will see is places like Orlando, which are the #1 place or #1 vacation place in the entire world. We did not see a decrease in people going to places like Universal Studios or SeaWorld or Disney World. In fact, Universal Studios in the last couple of years put a $275 million Harry Potter ride down there, which in the early stages people waited 8 hours just to get into to visit this single ride, and i.e. they spent all day standing in line to go on one ride, and then they walk through the tremendously marketing experience that they have in Universal and in Disney Studios, and that is they sell you a $40 Harry Potter wand, they sell you the chocolate factory, all sorts of stuff. You go out there with hundreds of dollars of merchandising, a tremendous business for them. Things have not slowed down, and there's lots and lots of jobs down there, specifically and close to the parks. This is just some of the things you can buy. This is things I've taken off the site just recently. Here is a Florida home. $58,000 is the asking price. Now the key here is that the asking price is $58,000. It doesn't mean you have to pay that amount. However, it is getting a little more aggressive down there. We're starting to see multiple offers on places. But anyway, $58,000. Rents at $900 per month, and this sold in 2007 near the peak for $160,000. It actually sold for $160,000. So you can see that that certainly isn't 60% off. It's a much higher rate than that. Moving forward, looking at Las Vegas too, we go down to Las Vegas. When we travel from east to west, and we're down and we're visiting our friends in Vancouver and our friends in Edmonton and Calgary down there, it makes a lot of sense for them to look at Arizona and Las Vegas. Here's an example, a condo down there. Prices are a little bit higher from the rental point of view, very similar inside. $59,000 asking price on the condo, rents out $1,100 a month. So it cash flows nicely for you. And in 2008, $240,000 price on this. Again, too, for my money, I'd rather be buying low and selling high, or certainly buying in a market that's low that has tremendous upside potential. When you look at that compared again to the Canadian market, where you're buying at a peak high, or certainly the highest we've ever seen in Canada for a whether it's a home or a condo. For my money, I would be down looking in the States. Daytona, they have something called a condotel. During the boom, what they did is they turned a lot of hotels into what they call the condotel. Hence the condo merging with the hotel. The term condotel came together. This one was purchased by one of our colleagues in Canada for $49,500 in 2011. In the high season, it rents for $1,200. Or excuse me, in the low season. Pardon me, right there, the low season, it rents for $1,200. This is sort of your September, October, November, and in the late summer where the humidity comes in there. But during the boom season, which tends to be Christmas on till around April, May, where Canadians flock to places like this as well as other people in the world, that is your higher or the high season where this is paying up to $2,400 per month. This was a quick flip for them. They bought it in 2011 for $4,950. They sold it in 2011 for, pardon me, $91,000. And no, that's not a mistake. They bought it in 2011, and 6 months later they sold it for $91,000 for a nice little flip profit in a very short period of time. This is the current market in Florida. We can see as the market really increased in value, sort of around anywhere between the 2007, 2008, peaked around 2007, and then started to come down. The one thing is we're starting to see some life down here. We're starting to see some change, and we're starting to, we believe anyway, that the bottom has occurred. I'm not going to say it won't bump around a bit more, but certainly the bottom has occurred, and we really believe now is the time, specifically for Canadians, to start to purchase investment property outside our country. Again, too, one of our favorite markets right down there now is Fort Myers or the Cape Coral. This is on the Gulf side. Again, too, you can see live example here. You can see the peak here. You can see the tremendous drop as the debt crisis occurred in the United States. You can start to see some life. So we can see our bottoming out around this, and we can start to see some increase. They're talking in the, at this point, they're talking in the Fort Myers and surrounding area, Cape Coral, Lehigh, of somewhere between a 10 and 20% appreciation in their market in this year alone. Again, too, tremendous value down there, and we are focusing heavily on that area right now. Fun part here is if you compare that to the stock market, which I showed, there's certainly no correlation here between the markets, but just an interesting, you can see when the stock market dipped, you can see what happened to that. So I'm putting some just a look at that, just for interest's sake, where this market may go. I'm not saying it's going to be there next year. I'm not going to say it's going to be in 5 years, but I can say one thing, that it has been up here, and there's a good chance we'll see that again sometime. A lot of people that were around in the 80s, When the peak hit in Toronto at somewhere between 88, 89, there was talk that you would never see the same kind of value here in Toronto again. And not only have we surpassed it, but we have surpassed it by a tremendous amount in Toronto. So there is sort of some of your proof that things can really change. The other thing I've said already and mentioned about is the Canadian dollar is at par. We haven't seen it. In fact, we've seen it 3 times at par in the last 30 to 40 years. So another tremendous opportunity for us to get our Canadian dollars out there, exchange them, and bring them across the border and buy discounted real estate. So when and if in the future it goes up in value, you can even exchange your money and make money just from the exchange rate. And if we see something crazy in the fluctuations where again we're paying a dollar for a 65 cent or dollar to get 65 cents American, we can see some tremendous upside just even on the exchange rate. So let's take a quick look at that. You can see the graph. You see the arrow right there. You can see where we are. They call it parity. We're pretty close to par right now, where 1 Canadian dollar is buying 1 American dollar. And what I'm saying here, the Canadians may get a chance to double dip, and that is if we start to see the American dollar strengthening versus the Canadian dollar, which we have seen in the last couple of months. It can really add some value if you get your American dollars or your Canadian dollars exchanged quickly for American dollars. Here's the next thing. They're starting to talk. The Asian market or the Chinese market is coming strongly. You can see this is fairly recent, February 25th, 2013. So we are up to date in our research. The Chinese are coming strongly into these markets and buying heavily, as you can see. What they were saying is that some of the Chinese couldn't get on the planes fast enough, and they're buying these things from pictures. At one time, Canadians were 39% of the buyers down there, and now the Chinese have taken a big bite out of that, and we're now 31%. And the rest is Asian buyers coming either across or buying from their homes. In this case, some investors are buying up to 35 units without even coming down to the States to take a look. That's the belief that they have in the market. Certainly it's a belief that we should take. Again, too, I talked a bit about interest rates, but it's the lowest interest rates we've ever seen in the last 40 years. This is a tremendous opportunity to get money out of your banks or take, loans. Take a look at your taking some equity out of your home at this point and looking at maybe putting some of that towards U.S. real estate investment. A tremendous opportunity down there. But again, too, doing anything, certainly when it comes to borrowing money to invest, you should certainly consult an expert, a financial planner if you have one, to get good quality advice from them. Finally, this is the shocking thing. Most people don't believe it, but there looks and appears to be a U.S. housing shortage. And I always get, how can that happen? And simply it's this. This was in CNN Money not too long ago, but simply it's this. If the builders, what happened is in 2008, when everything sort of fell apart in the United States, the builders just walked away from their land and their development opportunities and just left it sit. And typically we need to have a certain amount of homes. The number's about 1.3 million homes built every year in the United States just to keep up with population growth. And what we saw is that just fell off the tracks. We're starting to see the builders come back. But it appears that in the short term, once all the foreclosures and all the different buildings and that get bought up, we may actually have a housing shortage, which will put pressure on the housing markets. Again, too, giving us some tremendous value and bringing up the rates and the value for us as Canadians, or for those that get off the couch and start to take a look at this serious to build wealth. Finally, the money movement from north to south. We track the money movement to see where is the money going. And currently the money is moving, as you will soon see, to a place called Florida. What they do is Forbes takes a look at where the money moves. And I've put this in a pictorial view for you. You can see in the top 40 places, you'll see where the money moves. The first one is Florida. Next one is California, New Mexico, California, California, Florida, Texas, Florida, 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 Texas, 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 Georgia. That's because they couldn't get to Florida. Georgia, Florida, and the top place is a little place called Collier County in Florida. That is the #1 place where the rich or the people are putting their money. The money is moving from places like New York. Again, big money is moving down to places like Florida. Tremendous value down there. You can see that the money is moving. Where are people putting their money? I'm telling you right now, they're putting it in Florida. And here's the biggest thing. In the next couple of years, there's an undeniable trend. Whether we take advantage of this or not, most of us are going to be aware of what I've said because they've been talking about this from the time that this generation bought or was fed Gerber Foods till they bought a minivan to the present day. The undeniable trend is the baby boomers that are going to be retiring in the next 7 years. In Canada alone, there's 10 million baby boomers destined for retirement in the next 7 years. 78 million U.S. baby boomers and 1 billion worldwide will be retiring in the next 7 years. If you're down in a place like the U.S. and you yell out to the crowd, where did the U.S. retire? I'm going to tell you there's a resounding word that comes back, and the word is Florida. Over 33% of the world's purchasing power is coming from this demographic, and this demographic is going to be retiring. And here's what we find. 58% of that demographic want to move to a smaller home or condo. 51% want to move to a warmer climate. 46% want to move to a place with a lower cost of living. Certainly all three of them are easily identified in a place like Florida. To give you an example, recently down in Fort Myers with J.J. Childers and three of my colleagues, J.J. Childers and myself, 5 people. We were in a restaurant somewhere between a Keg and a Ruth Chris. We had a nice bottle of wine. We had cocktails. We had appetizers. We had steak dinner down there. Right on the lake. The total cost for the whole thing was $149. For those of you who've been to Ruth Chris, you can spend $149 on a meal for yourself, and that doesn't even include wine. Tremendous, tremendous value down there from a cost of living, from clothes to rent to food. Again, too, the resounding place is this little red place down Florida. Has all the bells and whistles, has the health, has everything you're looking for. And the nice part, it's about a 1.5 hour to 2 hour direct flight from here to the Toronto airport. So if anything happens sick-wise, you can get there quick, or if you have to get down there to check on your property or something for whatever reason, it's very quick. It always surprises me how many people will drive 3 hours to go up to their big, beautiful $1 million vacation property in Muskoka when you can just fly to a place like Florida and you've got a year-round vacation spot with a lot more relaxation, if you ask me. And here's the thing, we've just recently taken a look, and a lot of Canadians are getting really concerned since the stock market and everything has changed. The interest rates have changed. A lot of Canadians, their retirement dream is on hold. And you can see right here, only 27% of Canadians expect to quit working at age 66. That has changed a lot from about 5 years ago when the markets were looking good. At that point, 51% of Canadians believed that they would retire at 65. Just did a poll. This is from ages 33 to 35. 3/4 of the population think there's a real possibility of working past what was always thought as the traditional retirement age, which is 65. 3/4 is 75% of this age group, 33 to 35, see real concerns moving forward, and they believe that they will be not retired at the age of 65, but they will be working beyond it. 59% of the working age expect to retire with less than $250,000 in savings. That's a scary number for someone that's been in the finances as long as I have. If you look at $250,000 and put it into something quote-unquote safe, like a GIC or Canada Savings Bond, it's kicking you out anywhere between $2,500 and $3,000 on a yearly, that's not monthly, on a yearly basis, versus a number of years back, you might be able to get that on a monthly basis. i.e. $250,000 to invest on these days is not a lot of money. 38% feel that they're going to have less than 100. That's scary. 31% believe that they might not even be able to cover their medical expenses in retirement. And 38% are really concerned that they may outlive their retirement income. For those of you that want to see some real proof on that, for those of you who've been around for a while, if you go and check the local drugstore or Shoppers Drug Mart, at one time you would walk in there and you would see birthday cards, and you would actually turn a dial on there and it would say happy 50, and you could turn it to 60, 70, 80, 90. At one time there wasn't even 100 on it. Now when you go into the same stores, you will find there is actually printed material that says happy 100th birthday. One of the strongest and fastest growing demographics in Canada right now is those over 100. Currently there's 2,000 in Canada alone. To me, the way to get around all this and all the concerns is to seriously look at investing outside of Canada right now, specifically in the United States. Tremendous upside from the reasons I've just told you. And real estate. These are some of the pictures just for fun of some of the green flips that I've done in the past. And yes, that's me in the back actually doing my own work. For those of you that want more information on how you can work with us, because we've got tremendous experience down there, we love to help Canadians to become successful investing in U.S. real estate, go to our website, www.usrealworkshop.com. That's www.usrealworkshop.com. Get on that site, take a look. We're here to help you. Everything we do on the site, 100% guaranteed. If you're unhappy for any reason at all, we will certainly refund your money. And we look forward to seeing you on that site. And thank you very much for attending. Remember that work site, www.usrealworkshop.com. And we'll see you soon. Thanks for listening.